Hey, I just
I was just wondering if a date had been set for the final exam. I was just wondering if a date had been set for the final exam yet.
I don't know exactly. I mean, it wasn't last week.
Okay.
I get it the same day you guys can check it on time.
Okay, let's get started. Couple of quick notes. One is there is no class next Monday. It's President's Day. I don't even know why we get President's Day off. What are you going to do on President's Day? It's one of those gimme holidays like Mother's Day, Father's Day, invented holidays that I'm sure somebody invented because they want you to shop. But it's President's Day, so there is no class. And you know what that means, right? It'll give you a chance to get caught up. Because I do have some news that might sober you up. Your first quiz is not that far away. Don't act like you're all surprised. It's been on the damn Google Calendar right from the beginning of the class. Oh my God, first quiz is coming. It's been coming for a long time, but it's going to come the week after you come back is the first quiz. Which means that if you haven't even taken a look at any of the stuff in the class, you just let it ride by, it's time to kind of climb on top of the horse and make sure you are in fact getting the stuff. And I will send you some links on all past quizzes, so you'll have no excuse for not getting ready. So I'll do it today because you will, if you're one of those who wants to get ready ahead of time, this is a good weekend to get caught up. So your first quiz, in fact, we will, sometime during the course of this class, we will get to the point of the material where the first quiz will cover only up till that. So we'll not cover any of the stuff we do next Wednesday. So I'll let you know where in the slides we will stop for the first quiz. Okay, and final reminder, please make sure once you've picked your company that you go enter that company in the Google shared spreadsheet. I want to see every company, everybody filled in, because I have your names and I've locked in those names. So don't go and delete your names to make it look like you're not in the class. I know you're in the class. So I want to see a company next to your name, and if I don't start seeing companies, I will start emailing you, saying what company you're doing. You don't want that to happen, just go and do it yourselves. Okay, so let's start on today's issue. Today we're going to finish our discussion of cash flows, and we're going to start talking about the thing that worries most of us, creates discomfort, which is estimating future growth. And we've all talked, when we do finance class, we talk about the power of compounding. But I don't think we ever really think about how much power there is to compounding until we actually put numbers to paper. So I have a very simple intuitive question. We all know, everybody in this class has taken a foundations class, they know about the power of compounding. Let's see how good your intuitive feel is for the numbers. Let's say you're looking at a company, in this case LinkedIn. Okay? Let's say the revenues in the most recent year were $200 million. And you put in a 30% revenue growth rate on a compounded basis for the next 10 years. I just want a rough estimate. I know you don't need to do this in your head. I just want to get a rough estimate of what you think the ending number is going to look like, the number in your 10. $500 million, $1 billion, $2 billion, $3 billion, $4 billion. Let me go down each. Do it with your gut. I don't want you to be pulling out your calculator and doing it yet. We'll double check. Just go with your gut. Let's see how good your intuitive feel is. 200 million growing 30% a year for 10 years, 500 million. You don't have to put up your hand, just circle it if that's what you think. $1 billion, 2 billion, 3 billion. So you're going to start putting up your hands. So nobody did 500, 1 and 2. You're okay with it? So 3 billion, 4 billion? Somebody with a calculator, help me out here. What's 200? You can do it with your laptop. What's 200 times 1.3 raised to the power 10? I think it's 2.8 billion, somewhere around there. I think it's around close to 3 billion. This ain't big deal. I got that one. So let's say you're sitting there valuing your company. You put in a 30% growth rate. Your value is not high enough. You decide to double the growth rate. That doesn't seem like a big deal, right? 30 to 60. If I double my growth rate, do you know what my ending number is going to be, what my revenues in year 10 are going to be? It's $20 billion. I want you to remember that when you play with compounded growth rates, when you do valuation, be very careful, because you think, I'm just changing 42 to 45. You might just be adding $3 billion in revenues to your year 10 numbers. And I want you to think about running a business saying $3 billion in revenues. This is not manna from heaven that's going to land up on my income statement. Somebody's got to go make it. So it's so easy on spreadsheets to play with growth rates. But I want you to think about the consequences. The reason I bring this up is I'm valuing Snap right now. This is a big issue. Know how much in revenue Snap had last year? About $500 million. If I put in a 75% growth rate for the next 10 years, I make Snap into Facebook. If I put a 50% growth rate over the next 10 years, I make Snap more like Twitter. That's a big difference. My value can go from 10 to 35 billion if I make my growth rate go from 50 to 75%. So when I put in a growth rate, I always check my revenues in year 10, the dollar value, because that's going to sober me up a lot more than playing with the growth rates. One final question. This is something that you're going to be tempted to do when you sit down to value a company. Tempted to do what? You're going to be tempted to outsource this, because then it's somebody else's problem. So when I ask you, what's your growth rate, rather than you coming up with a growth rate, you're going to look outside. Somebody else estimated a growth for my company. And I'll save you the trouble. You're going to find growth estimates for almost every one of your companies. So if you're valuing IBM, there's an expected growth out there, usually from analyst forecast for the company. So you go to Yahoo Finance, you'll actually see a growth rate projected for this company by analysts. Now we'll talk about how much you should rely on that growth, but let's say you look at the growth rate, it says 12%. I want you to think about what number analysts forecast growth, and I'll give you the choices. Are they forecasting usually growth rates in revenues, growth in operating income, growth in net income, growth rates in earnings per share, or growth rate in any or all of the above? What do you think they more? When analysts project growth for a company, what is the metric that they tend to spend the most time on? Anybody who worked in equity research as an intern or something during the summer? It's earnings per share growth. You're saying, so what? You're sitting down to value a company. The growth rate you're going to be projecting is growth in revenues or growth in operating income, right? Growth in earnings per share is a horrible way of estimating those because you're climbing up the income statement. As you climb up the income statement, you have to start to get more conservative. What I mean by that, a 15% growth in earnings per share is a 10% growth in operating income, is a 6% growth in revenues. Because as you move down the income statement, you get leverage working in your favor. Operating leverage, fixed costs, as you go from revenues to operating income, and financial leverage as you go from. So when you come up with a growth for your company and it's much lower than what analysts are projecting for your company, there's a simple reason. You're projecting growth in revenues, they're projecting growth in earnings per share. Don't change your growth rate to theirs on the false presumption that they actually know what they're doing and that is in fact the right growth rate for your company. So we'll talk about all of these as we go through today. Maybe the analyst growth rate will hold off till the next session. But let me go back to where I left you on the slides. So I'm going to go back and very quickly review the two big adjustments we made to earnings. Okay? The first adjustment we made was for operating leases, right? So Anna, help me out. What did we do with operating leases? We capitalized them. Okay? Capitalized in the sense we converted lease commitments that are treated as operating expenses into debt. And when you capitalized it, you created a ripple effect, right? That capitalized lease commitment now became debt. It created an asset. You had to depreciate it. So your operating income changed, your debt changed. In a sense, your perception of the company changed. And also the return on capital you computed for the company. Think of the gap. Then we took R&D and we capitalized R&D as well. Why? Because R&D is really capital expenditures. Just because the accountant screwed up doesn't mean we should screw it up too. So we capitalized R&D. It was a little messy because we had to define a life for the R&D and look at the past R&D expenses. But the end result was not that we changed the cash flow. It stayed the same, but we now had a better sense of what income you actually made as a company and how much you reinvested. And also how well you were reinvesting, the return on invested capital. You give me a pharmaceutical company, if I don't capitalize R&D, I'm not getting a sense of whether this company is earning a 15% return on capital or a 6% return on capital. So when you look at your company, you're looking for lease commitments, and many of your companies will have it, but if they don't have it, don't freak out. There are companies where there are no lease commitments. Or if you have a non-US company, they just might not tell you that they have lease commitments. You're saying, what do? You can't fix what's unfixable. If the data is not given, you can't convert lease commitments. So let it go. And if you have R&D or R&D-like expenses, you want to capitalize them. So in the case of Snap, a significant amount of R&D expenses. Half their operating expenses are R&D. I gave it only a 3-year life because this is not the kind of business where you can wait 10 years for it to pay off. I capitalize R&D. It makes a huge difference. They still lose money. But instead of having an operating margin of minus 120%, they have an operating margin of only minus 81%. You think, big deal. The starting point is going to be different. So we capitalize R&D. And R&D-like expenses. Right? I know somebody's valuing Accenture. To talk to me before. If you're Accenture, what's your biggest asset? It's a consulting firm. It's human capital, right? What's a CapEx? So to grow, what do you need to do? You need to grow your human capital. How do you grow your human capital? What you spend on recruiting and training is essentially your equivalent of capital expenditure. It's going to be tougher to do for an Accenture because they might not separate it out. But you can see we've now opened the door to reclassifying expenses that we think have been misclassified. So let's move on now that we've got this adjusted operating income. You're ready to use it, but before you use it, take a look at your company's financials for the most recent year and the income for this, and check to see whether there are extraordinary items that are showing up in your income statement. You're saying, how would I know they're extraordinary? They'll be called extraordinary. That usually gives it away. Extraordinary income, one-time charge. So let's do a little what if on a company like this. Let's assume your company is reporting a loss of $500 million. Let's assume that that loss is coming about because there are a one-time charge, a restructuring charge, a write-off charge of $1 billion. You're sitting down to value this company. Last year they lost $500 million, but they also had this one-time charge of $1 billion. What would you use as your operating income for your base year to do your valuation? You could go with the minus $500 million because that's what it says it is. But that minus $500 million is what it is. Why? Because they had a $1 billion loss. Use common sense. If that $1 billion loss is a one-time loss and you truly believe the accountant when he or she says it's a one-time loss, what's going to be true about that item next year? It shouldn't be there, which means that when you project numbers out, remember your job is to forecast the future, not tell me what happened last year. That's just there as a structure for forecasting the future. I would suggest that you use $500 million operating profit and move forward from that, because that's what you'd have had without the one-time charge. But here's where it gets tricky. Companies have become very, very, very adept at moving regular operating expenses into what they call extraordinary expenses. You see why the advantage of that is? Because often you can report earnings before extraordinary items. And if you can classify something as an extraordinary expense, you push it below the line and make it look like you made money. In fact, in the late 90s, this got so bad that British analysts started inventing this term called EBBS, and it's not what you think it is. Companies report EBBS. You're saying, what's EBBS? It's earnings before bad stuff. Okay, so you're saying this year, our earnings before bad stuff was $800 million, but there's a lot of bad stuff, guys. The first year they said, okay. The second year they said, after the sixth year of bad stuff, you're saying the bad stuff, maybe that's your regular stuff. You should maybe bring it in and tell me what your earnings really are. There are these accounting games. They're not even breaking the rules. They're just bending the rules. There's enough discretion in the process. You're saying, how would I know? I remember valuing Xerox about 10 years ago. I looked at the last 10 years of financials. And in 8 of the 10 years, there was a one-time charge. Sometimes 1 loses its meaning if it shows up 8 out of 10 years, right? It's only an 8-time charge, but you're calling it a one-time charge. So let's see what you would do with a company like this. You look at your company's history in this case. Let's assume every 5th year you see a $1 billion write-off. It's like clockwork. If that were the case, and this was true for this company, what would you use as your base year operating income? The first case, I just said add the $1 billion back, act like you made it. But now I'm saying this $1 billion is showing up once every 5 years. What would your operating income base be? Want to try? Basically, what does it look like they're doing? They're taking a $200 million annual expense, bundling it up, claiming it as a one-time charge every 5th year, right? So I want to add back the entire $1 billion because $200 million of it would show up anyway. I'm going to add back $800 million. Do you see why $800 million? Because that's the amount that brings me. It means that my operating income will become $300 million instead of $500 million. You see how I get the $300 million? Minus 500 plus 800. So I'm adding back 80% of it. And my base income will then be $300 million. You think that's discretionary. Get used to it. Those are the choices you have to make in valuation. So one suggestion I would make is, last session I asked about S&P Capital IQ and you said you had access to it. One of the nice things about S&P Capital IQ is you can download data for the entire history of the company. So you can download an Excel spreadsheet. You don't even do it. So it shows up as an Excel spreadsheet from, so yesterday I did this for Google, from 2004 through 2017, every single line item. So I can check to see how often you take extraordinary charges just by checking that line item. Look at the history of your company. Don't act like the world began in 2016. There was time before that. Your company existed before that. Draw on that information as well. So any questions about a one-time or extraordinary charge? And this is true for extraordinary income as well. Is if you see an extraordinary income, you want to kind of take it out of the process because you don't want to act like that item is going to show up year after year after year. Now let's talk about accounting. I'm trying to be kind. Malfeasance, basically accounting fraud. Let's face it. If I'm cooking the books, then you're screwed, right? Basically, there's not a whole lot you can do because you're going to take my revenues, my operating income, my net income, act like I'm telling you the truth, and you're going to value the company. And one day you're going to wake up to what? The revelation that I've been cooking the books. At which point it's too late, you've invested in the company. So this has been a classic problem. It's actually gotten worse over the last 20 years as all these accounting rules have proliferated. It's worse in some countries than in others, obviously, but it exists in every market. So in the last big crisis period, which is 2001 and 2002 in the US, you started to see this new area of accounting called forensic accounting. Now there isn't very much accounting you could make me do. I would drive myself crazy. But forensic accounting actually is kind of fun. The objective of forensic accounting is to go through financial statements looking for clues that accountants are cooking the books. I'll give you one very simple example. You know how when you look at an income statement, you see operating income, net income? That's accrual income. That's called accrual income because it's based on accrual revenues minus accrual expenses. If you go to the statement of cash flows, the first part of the statement of cash flows is to start with net income, then add back the non-cash charges, and then subtract out change in working capital. That's called cash income. And some years accrual income. So if you take a typical company, accrual income will be higher than cash income in some years and lower in cash income in other years. There are some companies where you'll see cash income consistently come under accrual income year after year after year. Historically, that's been a good predictor of fraud. If consistently you report $1 billion in net income, but then I look at your cash flows and you're reporting a cash loss of $200 million, it's probably because you're playing with the working capital numbers, selling off stuff and not collecting on it. Okay? So cash income versus accrual income. Sudden jumps in effective tax rate. Some of you have probably noticed that for your company, the effective tax rate is negative. What the heck is that? I've never heard of the government paying you tax benefits. So what's a negative tax rate? You know why a negative tax rate shows up? It's because many companies have two sets of books and it's perfectly legal. Maybe it shouldn't be, but it's perfectly legal. One set of books is what we see, the reporting books, the 10K, the annual report. The other set of books is the tax books. That's what they show the tax guys. The taxes you pay are based on your tax books. So one reason you can get a difference is, let's say that in your tax books you claim accelerated depreciation. You claim big depreciation up front. And in your reporting books you report straight line depreciation. You're going to show an income which is much higher in your reporting books. What that effectively will mean is your effective tax rate will start wandering all over the place. It'll be minus 10%, plus 83%. That again is a red flag. By itself it doesn't mean the company is committing fraud, but it does mean you've got to be more careful with the numbers. So I will send you a couple of links if you're interested on things like that, flags that you can use. Don't spend your entire semester checking for flags, but you might want to do at least a couple of very simple tests to make sure that the numbers you're using, especially if you're working with an emerging market company, are numbers you want to build a castle on. So any questions on accounting, fraud, or on one-time charges? Which brings me to my, yes, go ahead.
What's the point of capitalizing an operating expense if you're eventually trying to calculate free cash flow to equity anyway?
Is that your objective? But be specific. Is that your objective? Because your objective would be computing free cash flow to the firm. You're saying, if I'm computing free cash flow to equity, should I capitalize leases? Is that the question you're asking? Because you don't have to compute free cash flow to equity, right? If you're doing free cash flow to the firm, it does make a difference because moving leases from operating to financial expense will affect my free cash flow to the firm.
Or just an operating expense in general, like R&D, for example. Since we're going to have to take the cash out anyways, then naturally it's going to be...
Okay, that's a different question. R&D, you're right. I admit it up front. Doesn't affect your free cash flow to the firm, right? So you're saying, why do we waste our time doing it? Somebody want to help me out? Why do we capitalize R&D if it's not going to change our free cash flow to the firm for last year? So you guys were willing to do this without really accepting a rationale for it? Come on. There's got to be a reason we do this, even though the free cash flow to the firm doesn't change.
So a lot of the big firms have majority of their operating income under R&D.
But that's fine. Your cash flow is going to be the same. So if I take Snap, whether I capitalize or expense R&D, the cash flow is going to be the same for last year. It's a big negative cash flow.
We're talking about like future projecting and all, and then you have this R&D is to
I think you're on to something. R&D is a capital expense, right? So even though you're subtracting it out as part of your operating expense, it's really a capital expense. Let's say you're valuing a technology company, and you take their bottom line the way they define it as after R&D. Can you see a very simple way technology companies can start to fool you? You're a technology company, your earnings are starting to lag. You're not doing very well. What are you going to do to make your earnings look better? Cut R&D. And if we do what we do with R&D, we say, great job, your earnings went up 20%, when in fact you've cut out the heart of your future existence. I want to see why your profits are higher. I want to see Apple's profits go up because they sell more smartphones. I don't want to see their profits go up because they cut their R&D by 50%. So by keeping the R&D separated from my true operating income, first I get a measure of where growth is coming from. Second, I'm also getting to keep tabs on their reinvestment to see if they're reinvesting well, because now with Apple, I can see how much they reinvested 5 years ago and how much their income went up this year. Let's say I find that their R&D is not paying off anymore, that their income is staying the same while they're pumping more and more money into R&D. I'm going to go back to them and say, maybe you need to cut back on R&D. And in fact, many pharmaceutical firms like Merck and Pfizer, that's exactly the advice I would give them is, hey guys, stop with this R&D thing. It's not working for you anymore. There's nothing inherently good about R&D unless it pays off in terms of higher earnings growth. So that's why we do it. That's actually a very good question. So if you're asked, why do we capitalize R&D? It's not to get a better estimate of the cash flow last year. It's to get a better sense of what this business is, whether it's doing well, and whether the business is reinvesting to create future growth. Now let's talk about negative earnings companies. At least 1 out of every 5 of you has to be doing a negative earnings company, right? Right, because everybody in the group. So I want everybody who's doing a negative earnings company to put up their hands. Okay, so this next 5 minutes, it's like one of those song dedications, is a dedication to you. So let's just focus on these poor people who've taken on the burden of valuing a negative earnings company. It is by far the most difficult company in your group to value, because valuing a money-making company is always easy. You know why? Because you don't get a high enough value. What do? You pump up the growth rate. You have a money-losing company, you're not getting a high enough value. You try pumping up the growth rate, you know what's going to happen? Your loss will get bigger and bigger and bigger. It's not working. So let's think about what to do with money-losing companies. And I want you to think about your company while I describe these generic examples. The first question you need to answer, if you have a money-losing company, is why your company is losing money. You're saying, that is really stupid. I know why my company is losing money, because its costs exceed its revenues. I know. But I want you to dig deeper. Why is your company losing money? And I'll identify 5 possible reasons, and I want you to think about which of these reasons applies to your company. It could be losing money because it just had a bad year last year. I'll give you an example. Every 7 or 8 years, Boeing loses money. Why? Because every 7 or 8 years, their labor contracts come up for renegotiation. And like clockwork, every time they come up for renegotiation, there's a strike. And when Boeing employees strike, they've got to shut down those huge factories that make their planes, and it takes them forever to get them restarted, so they lose about 6 months of production. So if you have a one-time thing, a temporary problem, that's your easiest problem, because if that was the reason you lost money last year, then you can do what we did with our very simplistic example, either add the whole amount back or take 1/8 of it and add, and leave it in the expense. So that's your easiest scenario. So if your company is losing money because of something that happened last year, you got the easy solution, add it back. If your company is losing money either because of cyclicality or commodity price ups and downs, again your problem is a pretty simple one to make go away. So I'll give you an example. You have a cyclical company, last year was a recession year. I can almost guarantee your company lost money. You're an automobile company. Why? It was a recession year. Recession years, automobile companies lose money. But you're valuing a company for the long term, right? And in the long term, there'll be recoveries and there will be recessions. So in a company where the earnings are going up and down because of either cyclicality or commodity prices, you're going to replace the current earnings, which are negative, with a normalized number. That sounds easier than it looks, because if I gave you a Royal Dutch, what's the question I'm asking? What's a normal oil price? And you can already see that this is going to be a challenge. We'll talk about how to confront that challenge, but there you're replacing the negative earnings with what you think the earnings would be in a normal year over the cycle. So those are your two simpler scenarios, because there you're basically fixing the negative earnings right away and then you're moving on. Here are the three more difficult scenarios. Why is Snap losing money? They're a young company. They've just started up. They haven't built up a business model. They have lots of expenses. They're losing money because they're early in the life cycle. So when I'm valuing Snap, I can't magically, click my fingers and say, I'm going to make the earnings $1 billion next year, because it's not going to happen. So if you have a young company, you're going to lose money, because that's the nature of being a young company. Most young companies lose money as they build up infrastructure. It could be that your company is losing money because it borrowed way too much. The good times, many oil companies have this problem. Now they're losing money, and as their leverage decreases, they might make money, but that's going to take a while. Or your company could be losing money because it has some deep structural problem. Today you probably read that Toshiba's CEO quit, fired, harikari, whatever. In Japan there's a big deal. CEOs leave, they don't leave. It's very ceremonial. Take the sword, put it on my stomach, and oh my God, I'm so sorry I did this to you. Just leave, right? Just don't do this. Enough. But the problem for a company like Toshiba, and this is actually, I think, a pretty solid, pretty universal problem with Japanese companies, is many of them have structural problems. They were designed and built for a different age, and now they don't know what to do. In all three of these cases, notice what they share in common: young life cycle companies, highly levered companies, companies with deep structural problems. Your losses are not going to go away next year. They might not even go in the next 3 years. It might take you 5, 7. For these companies, here's what you need to do. You need to have a vision of what recovery looks like for this company. What does that mean? You can tell me what their profit margin will look like if they recover, if they make it back to health. If it's a young company, I need to estimate for Snap, and this is actually the number I'm kind of stuck on right now, the Snap valuation, is what would a healthy Snap earn as an operating margin? So where do you think I'm looking for that number? I could look at Twitter, but that would be the bad place. Healthy and Twitter don't go together. I'm looking at Facebook. Facebook's operating margin is 45%. It's astonishingly high. Google's operating margin is about 22%. And if you look at online advertising space, the companies that are large are probably have margins between 25 and 30%. I don't think Snap is going to be Facebook-like. It's not that kind of company. It's built more for a niche market, younger market, a market that's more attracted to visual social media. So the margin I'm going to give it is 25%. How do I know it's going to be 25%? I don't. That's my story. You don't like it, change it to 45%. But that target margin is what I'm going to use, and I'm going to coax on my spreadsheet the margin that right now is 90% or 86%, minus 86%, down, and over time I've got to improve it. And when I send you the spreadsheet, as I'll make it the next week's valuation of the week, you're going to see me try to estimate how quickly the margin is going to move towards a plus 25. And that's again a place you and I could defer on. You could say, I think the pathway to profitability is a lot more rocky. You're talking about how to move your company towards a margin. But with these three groups of companies where the problem is deep-seated, don't change the negative to a positive. It's not that easy. You have to make that judgment about a margin. And there's always this one thing that's going to be hanging over your valuation, right? What happens to many money-losing companies? I wouldn't say most. What happens to many of them? They don't make it. So here I am devising pathways to nirvana, and hell might be waiting for you somewhere in year 3 or year 4, right? So I'll talk about what to do. When I value Snap, I can't let that thought even creep into my mind because it will destroy my valuation. So I'm going to value Snap on the assumption it's going to make it. And the last moment I'm going to wake up and say, what's the chance it's not going to make it? And if I say that's 20%, what do you think your equity is going to be worth that 20% of the time? You liquidate Snap. What are you liquidating? Those Herman Miller chairs? Now, there's not much to liquidate. Not like your physical assets, land, building, equipment. So you're basically going to end up with an equity value close to zero. So we'll talk about what to do in that other bad case. But when you're doing DCF, keep your optimist hat on. with these negative earnings companies until the last moment. So that's money-losing companies. Whatever that worked for you, do it for your company. Now let's talk about tax rates. When we talked about after-tax cost of debt for your company, we talked about what tax rate to use, right? What was the tax rate used for after-tax cost of debt? Always the marginal tax rate, right? Because interest saves you tax as the margin. When you do levered betas, always the marginal tax rate. Now, the question I'm going to ask you now is about tax rates in a different context. So, the cost of debt, cost of capital goes in the denominator. Now you're talking about getting cash flows. So here I'm talking about the tax rate I should be using to come up with my after-tax earnings. And I'll give you the choices. I could use the effective tax rate that this company reports in its financial statements. Last year, that average across all US companies was, as I said, 26 to 28%. I could use the tax rate that I compute by taking taxes paid and dividing by EBIT. So basically, I'm computing my own tax rate by looking at what you actually pay in taxes divided by the operating income. I could take the marginal tax rate of the country in which your company operates in. I could take a weighted average marginal, this is going to be a nightmare for a company like Coca-Cola, right? Weighted average marginal tax rate across all the countries you operate. Maybe the answer is none of the above, in which case you better be willing to tell me what you're going to use instead. Oh, this would be nice if it were true. Maybe any of the above works as long as you use that same tax rate all the way through. You know why that would be nice if it were true? If it were true that all you had to do was be consistent, what's the easiest tax rate to work with in valuation? 0. I would value every company. No taxes, no taxes. That was great, that was great. But it wouldn't be realistic. So taxes matter. The question is, what tax rate should I use? And broadly speaking, the question I'm asking is, should I use an effective tax rate or marginal tax rate? With cost of debt, it's always a marginal tax rate. But with earnings, should I use an effective or a marginal tax rate? I'll let you think about that for a moment. How many would go with the marginal tax rate? Anybody with a marginal tax rate? So I would say if you actually have a point of view at all. How many of you will go with an effective tax rate? That's a lot of people who don't have a point of view on the tax rate. Right? So let's take the effective tax rate. Now, we talked about why effective tax rates are lower than marginal tax rates last session, right? We talked about foreign income. We talked about the fact that you get tax credits. And we also talked about the fact that you defer income. So let's say your effective tax rate is 26% like it is for Apple, and I make that my tax rate to use on my cash flows and earnings all the way through. What am I assuming about deferred taxes when I do that? If I leave the effective tax rate at 26% from year 1 all the way through infinity, what am I assuming about deferred taxes? That I can keep deferring taxes forever and it never catches up with me. And if you believe that, there's a padded cell in a federal penitentiary waiting for you. You defer taxes, you can keep deferring, but eventually it catches up with you. You know when it starts to catch up with you? As your growth rate starts to level off, your tax rates start to catch up with you. Because as long as you have growth, you have this discretion. You can keep pushing taxes into future periods, but your taxes catch up with you. I'm kind of giving you the solution. So to value a company then, what should you use as a tax rate? Use both. Start the process of using the effective tax rate in years 1, 2, and 3. I'm not saying you can't defer taxes, but as you move towards your terminal value, push your tax rate to what you believe will be the steady state tax rate. Okay? And unfortunately, we're at a point in time where we don't know what that steady state tax rate is going to look like for the US. So last year, if you'd asked me to do this, I'd have started 26 and moved them to 40. And so why are you making such a big deal? That's the marginal tax rate in the US. And of course, now that we have this debate about rewriting the corporate tax code, I don't think 40% is going to, it's not long, it's going to pass through. Sooner or later, it's going to be lowered. The question is to what? For my Apple valuation, used a 30% tax rate. I think that's where we're going to end up. I have no idea. It's not like I have some inside information on this. I don't see it going to 15, which is one of the numbers I see floating around. So my guess is we're going to end up around 25 to 30, which actually makes our lives a lot easier because it means for many companies, effective and marginal tax rates are going to be much closer. So let me review. For cost of debt, always use the marginal tax rate. For earnings and cash flows, you can start with the effective tax rate, which is low, and then build up over time towards a marginal tax rate. Which brings me to one final little detail. When you lose money in the US, and this is true pretty much around the world, you don't pay taxes, right? And when you lose money, you're allowed to accumulate what's called a net operating loss, or an NOL. And you're allowed to carry it forward and offset it against taxable income. Yes?
For the marginal tax rate and calculating cost of debt, I'm not understanding why you would use effective, because if you had very low effective taxes, wouldn't your debt shield be worth less?
Right. That's actually a very good question. The question is, when you have very low effective tax rates, why wouldn't your debt tax shield also be very low? I'll take the example of Apple. Right? Apple's effective tax rate is 26%. Why? Because their income is global. But where did we say they borrowed the money? All $94 billion of Apple's debt is in the US. They claim the interest expense only against a US taxable income, which is taxed at 40%. So they actually get the full tax benefit of debt by... See, companies don't borrow money around the world in proportion to where they do business. They borrow money strategically in the places where they get the biggest tax benefit. So even the oil companies and mining companies that have tax credits, they still manage to find the portion of their income that's taxed at the 40% tax rate. And every company has some portion that's taxed at the 40% tax rate, and their interest expenses magically move to meet that income. So that's why I describe the US tax code as incredibly perverse, because by having a high marginal tax rate, you're giving companies this huge benefit in borrowing money. But because you collect only 25 to 26% in effective taxes, you are not collecting the taxes that you marginal. So that's why you can have two tax rates. Your cost of debt will still be at the 40% tax benefit, because that's where your interest expense saves you taxes. But your overall income, which is what you're looking at here, gets taxed at 25 or 26%.
So, but what about for maybe a less mature company than Apple that is running at a low effective?
Even there, I guarantee you, if you're paying taxes, some of your income, because no company, it's not a tax bracket issue. US companies, you hit the top tax bracket, which is 40%, around $2.5 million in income. So almost every corporation has some income that is above the $2.5 million. The reason their effective tax rate is low is not because of tax bracket issues as much as these tax credits and other stuff that they get on some portion. The pharmaceutical companies, for instance, if they have a Puerto Rico operation, pay no taxes on it. So when you look at their effective taxes, they will be low, but they're not going to borrow money in Puerto Rico to claim against an income. It'll always be in the US. So you get the best of both worlds as a company. You pay the low effective tax rate in your overall income and get the high tax rate benefit on your debt. Okay? So now let's talk about net operating losses. Okay? So let's say a company, this is a money-losing company. Again, this is going to be an issue. Take a look at the annual report, or 10K. Somewhere in there it'll tell you how much the company is carrying forward as an NOL. What does that mean, carrying forward as an NOL? These are losses from previous years that they haven't been able to use yet. So let's see how you would build this in. Because this is a classic investment banking question, and since the person asking it often has barely any idea what to do with this anyway, I'm going to talk about how to do this right, and maybe then tell you how you might want to answer the question for... You might have to gauge the ignorance of the person asking the question. So I'll tell you what you should be doing, and then maybe you can explain to the investment banker why he or she should do the same thing. So let's say you have a company that has $1 billion in NOLs it's been carrying forward. Right? This company is expected to have $500,000 in taxable income every year for the next 3 years. So I have a very simple question. What is the effect of this NOL? How will it show up in your cash flows? I've given you the pre-tax income, right? The operating income. Tell me how much you'll pay in taxes in year one. You have an NOL of $1 billion. You made $500 million, so you report no income, no taxes. So year one, your taxes are zero. Your after-tax operating income is $500,000. Year two, you now have used up half of the $1 billion, so you have another $500 million left over. Use that to cover income in year two. You pay no taxes in year two as well, so you get zero in taxes, $500 million after-tax operating income. What happens in year three? The NOL's gone, and if your tax rate is 40%, now your taxes will be $200 million. What does that mean? When I do my cash flows for this company in years 1 and 2, I'm going to have $200 million more in cash flows each year. Why? Because the NOL saved me taxes in those 2 years. When I do my valuation, the value of the NOL is already in my value because my cash flows in year 1 and 2 were affected by the NOL. The best way to deal with NOLs is not to keep them separate, but to bring them into your tax calculations. It's a bit of a pain because when I value Snapchat, they have about only $300 million in NOLs, but you know what's going to make it messy? I expect them to lose money for the next 4 years. So what do I have to do next year? I have to estimate my loss, add it to the NOL. There's an NOL line item that I have to keep track of. So each year for the next 4 years, that item is actually going to get bigger. So by the time I get to year 4, my NOL is going to be $1.5 billion because I'm expecting them to lose another $1.2 billion over the next 4 years. Then they start making money. And in years 5 and 6, I don't pay taxes. Legally, because I have the $1.2 billion. Year 7, I finally use up the rest of the NOL. They don't pay their full taxes. Year 8 is the first year that they fully pay taxes. And it's already in my cash flows. I don't have to do any other stuff. It's built into my valuation. So any questions on taxes? So we've got the after-tax, or it took us a while to get there. We've got EBIT times 1 minus 3. That's all we've done so far. Let's talk about net capital expenditures. Remember the way I described this, right? It's what you invest in long-term assets. Unfortunately, when I say CapEx and depreciation, you think accounting. Because in accounting, there's a very specific definition that goes with these two items. And you go to the statement of cash flows, you see the accounting concepts for CapEx and depreciation. And we already talked about why that doesn't work. One is, if you have a company with a lot of R&D, looking at CapEx and depreciation gives me a very skewed vision of what this company is reinvesting. So if I look at Amgen's CapEx and depreciation, I'm not getting a sense of what Amgen is reinvesting. So the first problem I'm going to run into is if I go with the accounting definition, it looks like big technology companies, big pharmaceutical companies are not putting money back into the company. And that's going to affect my growth rates, my value, etc. Here's the other thing to keep in mind. You familiar with Cisco? Cisco was one of the great growth stories of the 1990s. It's a company that went from having a $4 billion market cap in 1990 to briefly being the largest market cap company in the world in 1999, $400 billion. 4 to 400, that's pretty good, right? You know how they got there? It's still their modus operandi for growth. How did Cisco grow? They did about 20 acquisitions every year. So they acquired these small technology companies, and their skill then was to convert these promising technologies into products. You think, so what? 2/3 of these acquisitions they paid for with stock. They paid with shares. So if you went to the financial statements and you looked for those acquisitions, you wouldn't find them in the statement of cash flows because they didn't pay cash. And if you weren't careful, you wouldn't even know that they'd done them until you went and looked at the footnotes. I'm going to argue that if you're valuing a company and you're growing through acquisitions, and you're going to count the growth from the acquisitions, and you've got to count the cost of these acquisitions as part of your CapEx. Even if they're paid with stock, you think it's not a cash flow. You just skipped a step, right? If you'd taken those shares, issued them to the market, taken the cash and done the acquisition, it would have been a cash acquisition. I cannot let you use a barter system to evade cash flows. So in my definition of net CapEx, not only am I going to include things like R&D, I'm also going to count acquisitions. So just show you how much of a difference it makes. When I talk about capital expenditures, I'm going to include the R&D. And if you remember, the way I did that was I added back this year's R&D expense and subtracted the amortization. And I'm going to count in acquisitions. And here's how much of a difference it makes. Cisco in 99, that was their peak year. That was their absolute pinnacle of their growth. Had 1, 2, 3, 4, 5, 6, 9 companies that they acquired. They spent $2.5 billion on the acquisitions. You say, what the heck is purchase versus pooling? Pre-2000 in the US, if you paid for a company with shares, you were allowed to use what was called the pooling method, which allowed you to not have to capture goodwill, all that stuff. So those poolings are share-based acquisitions. So many of their biggest acquisitions they paid for with shares. The purchase they paid for with cash. So the purchase, the cash-based acquisitions, I could see in the statement of cash flows. The pooling, I actually had to dig through the footnotes to see how many shares they used and how much it cost them. Collectively, on all of those acquisitions put together, they spent $2.5 billion. You think, where is this going to show up? When I did the free cash flow for Cisco, here's what I did as my net capex. I started with what the accountant told me the net capex was. So I went to the statement of cash flows, and according to the accountant, you subtract the depreciation of the capex, it looked like Cisco reinvested less than 100 million, 98 million. That's almost nothing for a $400 billion company, right? That's horrible if you're going to grow. How are you going to grow? Well, the reason it's so low is first they missed R&D entirely, so I had to adjust for R&D, which adds about a $1.1 billion to their net capex. So I did exactly what I did last session, capitalizing R&D. And then I added the acquisitions of $2.5 billion. And magically, my net capex has gone from less than 100 million to $3.6 billion, or $3.7 billion. Cisco, in my view, reinvested $3.7 billion in 99 back into the business. Is that a good thing or a bad thing that they reinvested so much? It's both, right? What's the bad news about reinvesting $3.7 billion? What does it do to your cash flows when you reinvest a lot? Your cash flow becomes more negative, right? You think that's bad news? What's the good news about reinvesting $3.7 billion? When I project Cisco's growth, I can say, hey, they're putting a lot of money into the company, so I can give them a 20% growth rate. Growth has a good side and a bad side. The bad side is captured by the fact that your cash flows go down, you're reinvesting. The good side is captured by the fact that you are going to be able to grow faster. The net effect is what's going to drive the value of growth. But to do that, I need to be specific about what I'm reinvesting back in the business. Yes?
Does this mean that investors value cash flows more than reinvestment?
Why is it either or? Reinvestment is a cash flow. So reinvestment itself has no value. It's a cash flow effect. What's a cash flow effect? It's a negative cash flow. So what's the good news that comes from out of reinvestment? You have a negative cash flow this year, but what do you hope to get in the future? Higher positive cash. Everything is a cash flow effect. So the reinvestment effect, the year you do it, is always a bad news, right? You have negative cash flows. The good news is now that you put all this money back into the business, you hope to get higher cash flows in the future. That's a growth effect. So everything is about cash flow. So it's not cash flow versus reinvestment. Reinvestment is a cash flow. And you're weighing it off against future cash flows you get from that reinvestment. Any other questions? Let's talk about working capital. So somebody who's good at accounting, help me out here. Or even bad at accounting or average at accounting, I don't care, right? What's the accounting definition of working capital? Come on. I'm not going to jump down your throat. It's easy. What is it? Current assets minus current liabilities, right? That's the way you were taught accounting. That's the way I was taught accounting. Now I want you to forget that definition of working capital. Because in valuation and corporate finance, that's not the definition we're going to be using. In valuation and corporate finance, when we talk about working capital, we talk about non-cash working capital. So when I do working capital, I'm going to take non-cash current assets. I'm going to strip the cash out of the current assets, and I'm going to subtract out non-debt current liabilities. What does that mean? I go into current liabilities, I strip out short-term debt, short-term portion of long-term debt. Where does that go? It goes into debt for the cost of capital. I can't double count. So it's non-cash current assets minus non-debt current liabilities. So I've already told you why I take debt out of the liability side. Let's talk about why I take cash out of the asset side. This is going to make a big difference, right? Because if you think about Apple, if I leave cash as part of working capital, it's huge. It's 1/3 of the company. And I'm taking it out. So let's step back and think about why working capital affects cash flows. And let me pick a line item in working capital that we're all pretty familiar with, inventory. So you're a retail store. Your inventory increases. What does that do to your cash flows when your inventory increases? Decrease your cash flow or increase your cash flow? Decrease. And tell me why. Intuitively tell me why having more inventory is bad for your cash flows. Sorry? You spent money and it's sitting on the shelf, and while it's sitting on the shelves, it's wasting asset, right? So inventory is a wasting asset. That's why we include in working capital. You sell items on credit. You don't charge interest. It's a wasting asset. So here's my question. Is cash a wasting asset? Or let me rephrase the question. What has to be true for cash to be a wasting asset? Or nothing to invest in, right? Let's say I took Apple. That $250 billion in cash makes about 1%. That's horrible, right? But is it? What's the cash when you see cash in marketable securities for a US company, where is that cash usually invested to be cash in marketable securities? It has to be invested in something short term and something close to riskless. So it's got to be commercial paper of highly rated companies or T-bills. So I have a question for you. Now, if you have a portfolio of savings, you notice that money that you sweep into your money market fund for the last year, have you checked out what interest you've been making on that money market fund recently? Don't. It's very depressing. Because I checked yesterday, just because we're ready for this class. I made 0.08% as my interest last year. I should send a letter to Schwab saying, how dare you, you thieves. But actually, that's what I would expect to earn. Why? Because the T-bill rate for much of last year was about 0.1%. It's not like they're ripping me off. It's if I invested in something liquid and riskless, I would earn a very low rate of return because the rate on something liquid and riskless. So, do you see where I'm going? Apple has $250 billion that makes 0.1%. I might not like it, but it's what I would earn. It's a fair market rate of return on something liquid and riskless. That $250 billion is not wasting if it earns a fair market return. 95% of what you see as cash balances at companies is invested in things like T-bills and commercial paper. You can let it go. It's not a wasting asset. So what's got to be true for cash to be a wasting asset? You could have stacks of currency sitting around your business. I don't know what kind of business you're running. Maybe you're a Colombian drug cartel. If that is the case, then I understand. Then you want to hold the cash because that's how you do business. If you ask me to value, I think twice about accepting this assignment because I'm not sure what the consequences of getting the value wrong are. And then I would start counting the cash, saying, you have a lot of working capital, don't you? And say, yes, I do. I need it. Right? If your business is a currency business, then cash can be part of working capital. Some of you might have been reading about the demonetization in India where 85% of all, this is a cash-based economy. 85% of the cash in the economy, they asked you to bring it in. The only problem is they couldn't print off the new notes, so basically they said bring it in, but we might not give you the money back until 2 months from now, 3 months. In a cash-based economy, it's deadly. But one of the things that will come out of this is they're pushing people to adopt more digital ways of paying. There will be consequences. Retailing in India is still very much a mom and pop operation. Small businesses which are entirely cash-driven, which creates all kinds of consequences. Nobody pays taxes because you have no idea what the revenues are, what the expenses are. But this will have consequences for things like working capital in India because the less cash you need to hold as a business, the less I have to worry about bringing into working capital. So with a company like Tata Motors, it was never an issue. But if I were valuing a small retail company in India, I might use a lower working capital need now that you don't need that currency standing around or sitting around to run your business. So we're talking about non-cash working capital. It's a change in that number that drives your cash flows. So with that perspective, let's look at 3 issues you could run into with working capital. Okay? The first is, when you look at working capital and you try to project it, you're going to be tempted to do it with detail. Inventory, accounts receivable, accounts payable, supplier credit. My suggestion is don't go there. It's not worth it. Why? Because unless you have this special power to forecast receivables for the next 30 years, why are you wasting your time? I have never done a valuation where I've broken working capital down into its constituent parts. I've always done the aggregate because I want the law of large numbers to work in my favor. If I get receivables wrong and payables wrong, maybe it'll average out. Hopeful thinking, but I do aggregate numbers. Second, working capital is one of the most volatile numbers you will see in cash flows. So you'll see a company with increase in working capital one year, decrease the next year. Basically, it jumps all over the place. Why does it matter? If you take last year's change in working capital, be very careful. That number might not be indicative of what the company does over time. So that's the second force to keep in mind. The third factor is, can your non-cash working capital be negative? What is it? Non-cash current assets minus non-debt current liabilities, right? Technically, there's no reason why it can't be a negative number. And there are entire sectors where the number is negative. You're saying, so what? Let's say you let revenues grow in this business, and you have negative working capital. What's going to happen to your cash flows? They'll actually get more positive, because the more your revenues grow, the more negative your working capital becomes. You're actually using supplier credit to grow. That's what you're doing. So it can happen. What you do about it will depend on the company you value. So to kind of illustrate that, let me give you 3 companies that I valued in 99. So this is actually with the first edition of one of my books, The Dark Side of Valuation, was about valuing tech companies, young tech companies. And 3 of the companies that I valued were Amazon, Cisco, and Motorola in the group. So basically, I computed the working capital for each company and the revenues for each company. I computed working capital as a percent of revenues, as well as the change in working capital in the last year. For all 3 companies, working capital decreased in the previous year. So it was a cash inflow. But here was the difference. Motorola normally has a positive working capital. The other 2 actually had negative working capital. When I valued Motorola, here's what I did. I ignored the change in the last year, because it's part of the year-to-year change. To forecast out what I would use as my change next year, I just assumed that when revenues change next year, the working capital change would be 8.23% of that number. So in the case of Motorola, I used the average working capital as a percent of revenues from the most recent year as my way of estimating what would be next year. With Amazon, change in working capital was negative. And this is unusual, because usually retail firms, working capital is a drain on your cash flows. For Amazon, it's a plus, at least in 99. In fact, many people who actually suggested you invest in Amazon in 99, one of the things they pointed to was this model that Amazon had of using supplier credit to grow. It actually sounds like a great way to grow, because you don't pay interest, it's free credit. And the way it worked at Amazon was, at that time, it was one of the few online places you could sell your stuff, and they were primarily a book retailer at that time. So if you were a book publisher, you would send your books to Amazon, 500 books, and you'd say, pay me off in 3 months. So they got supplier credit. You bought the book on Amazon. And Amazon says, pay me in 3 months. No chance. They want you to pay right away. So they would collect your money from you when you paid and wait to... So basically, they were using that cycle as a way of funding themselves. So I could see why the working capital was negative. But I could also see that this was a sector where typically working capital turns positive at some point in time. The sector's working capital requirements were about 8.71% of revenue. So looking across all retailers, working capital is 8.71% of revenues. Amazon just stands out with negative working capital. In my valuation of Amazon, I grew Amazon's revenues and went from a small company to a big company. I made the assumption that as Amazon grew, its working capital requirements would go from negative to positive, that they could not keep this model going. Because if you're a publisher and you're selling a third of your books or half your books through Amazon, you can't afford to give it to them and pay me in 3 months. You have to start asking for payment on a more reasonable time frame. I didn't push it up to 8.71%. I left it at 3%. You know why? Because Amazon does not have to maintain what I call show inventory. You know what show inventory is? You walk into a brick and mortar bookstore. Notice how they have these entire sections of the bookstore where nobody seems to hang out. That philosophy section, what the heck is it there for? Let's face it, people walk into the bookstore, there's this big stack of Harry Potters in the middle, people buy it and they leave. The rest of the bookstore, you're supposed to do it. As a bookstore, you can't just have, James Patterson and Harry Potter. You got to make it look like you're an intellectual place. So you have all this show inventory to make it look like, hey, look how intellectual we are. Amazon doesn't need show inventory. If nobody's buying a philosophy book, they don't carry a philosophy book. You want to buy a philosophy book, they say, well, get somebody to write it for you and send it to you. That means that in steady state, they will have less working capital. So when I valued Amazon, I stopped at 3%. And finally, I looked at Cisco. Also negative working capital like Amazon, but this is a company in a sector where everybody else also has negative working capital. So when I valued Cisco, here's what I did. I left the working capital as a negative number in the near future. Cash could still come in. But as I pushed out towards my terminal value again, I pushed it towards 0%, simply because I don't want accounts payable and supplier credit to become this infinitely large number at some point in time. So 3 very different responses to 3 companies, which basically means anything goes. You've got to make the judgment that best fits your company. Take a look at its history when it comes to working capital. So that's cash flow to the firm, net capex, and change in working capital. Any questions on either of those? So let's close this process by looking at cash flow to equity. If you look at the historical way in which cash flow to equity has been defined, it's dividends. After all, that's the most honest way of thinking about equity. That's the cash flow you get. The problem with focusing on dividends is we know conclusively that companies don't pay out what they can afford to in dividends. How do we know? All you have to do is look at the cash balances, right? So when you focus on dividends, you're going to undervalue companies in general. There are some companies we might overvalue, but you're generally going to undervalue because you're looking at what they actually pay out. So one of my struggles when I wrote my first edition of my valuation book was, you're valuing equity. You can stay with the dividend discount model, but by doing it, you're missing all those other cash flows the company's throwing out. Could I estimate the potential dividend? And for those of you in my corporate finance class, we talked about how to estimate. It's not rocket science. Potential dividends are cash flows left over after you've met every conceivable need. So here's a classic way of thinking about potential dividends. Potential dividends, you start with the net income, then you look at what you reinvest, you look at debt payments. What's left over is your free cash flow to equity, a potential dividend. Your potential dividend is not your earnings. I've seen people value companies with earnings. Don't do that. Earnings are not cash flows. They can't be paid out as dividends. You have to go through the work of estimating what that free cash flow to equity is. So I'll show you the process by doing it. Just think intuitively of what I'm trying to do. So I want to estimate what you have as cash flows to equity. So I start with the net income. Why net income? Because it's equity. I'm looking at equity income. I subtract out net capex, just like I did for cash flow to the firm. What's different here, though, is I've added that line item for debt repayments and debt issues, because that's cash coming into the firm and cash leaving the firm. That number is my potential dividend, the free cash flow to equity. When I value the equity in a company, rather than use the actual dividends, I'm going to use these potential dividends. So let me try an example. This is actually a company, there's a shortcut you can use if you're willing to make an assumption. You start with the net income, you subtract out net capex and change in working capital, and then you subtract that debt cash flow. If you're willing to assume that the debt ratio you're going to use for this company is stable, in other words, 30% of your reinvestment is always going to come from debt, the shortcut that will give you the free cash flow to equity is you start with the net income, you subtract out, let's say, 70% in this case, 30% comes from debt, 70% from equity of net capex, 70% of change in working capital, you end up with a potential dividend. Each case, you're trying to estimate what's left over after your reinvestment and after your debt cash flows. So let's take a simple example. This is Disney in 1997. Their net income was $1,533 million. Capex was $1,746. Depreciation was $1,134 million. The debt ratio they'd been using for a while, and I use this as a steady state, was about 23.8%. And their working capital increased by $477 million. So I wanted to compute the free cash flow to equity, the potential dividend that Disney had in 1997. So I start with the net income. I subtracted out the net capex, which is $612 million, times 1 minus the debt ratio. Do you see why I do the 1 minus the debt? I'm looking at how much of it has to come from equity. So if 23.8% comes from debt, the remaining 76.2% comes from equity. There's my equity portion of my net capex, the equity portion of my change in working capital. My free cash flow to equity for Disney was $704 million. That's what they could have paid out. What they actually paid out was $345 million. Now you can see why using a dividend discount model is going to undervalue Disney, because you're focusing on the 345 rather than the 704 million. So I want to ask you a what if question. So in this case, what did I use as my debt ratio? 23.8%, right? I got a $704 million free cash flow to equity. If I funded 50% of my reinvestment from debt instead of 23.8%. What's that going to do to my free cash flow to equity? Is it going to increase it or decrease it? So I now have to come up with less money as an equity investor, right? So I'm going to end up with a higher free cash flow to equity. If I use 80% from debt, 20% from equity, it's going to go up even more. This looks like an easy way to make your equity worth more, right? As I increase my debt ratio, my free cash flow to equity keeps going up and up and up and up. So doesn't that mean your equity value should go up as your debt ratio goes up? What am I missing when I focus on this table? More debt makes my free cash flow to equity higher. But when I use free cash flow to equity, what's the discount rate I should be using on that cash flow? Cost of equity. Where does the cost of equity come from? It comes from a risk-free rate plus beta times risk-free. Where does the beta come from? An unlevered beta and a debt-to-equity ratio. Do you see the other shoe waiting to drop? If I use more debt to pump up my cash flows, what's happening to my beta and cost of equity while I'm doing this? My beta and cost of equity are also rising. So my cash flows go up, my beta and cost of equity go up. Let's close with the question. What's happening to my value of equity? And I'll give you the choices, and you tell me which of these you think might happen as I increase my debt ratio. Increasing leverage will increase value because my cash flow effect is going to dominate my discount rate effect. That's the first answer. If that were true, what should every company do? Borrow as much as they can, 99% debt. Increasing leverage will decrease value because the risk effect will dominate the cash flow effect, in which case companies should never borrow money. Increasing leverage will not affect value because the risk effect will exactly offset my cash flow effect. That's kind of magical, right? In fact, there's a theorem in corporate finance, one of corporate finance's most famous theorems, that makes exactly this argument. It's called the Miller-Modigliani theorem. Miller-Modigliani theorem says as you borrow more money, your value doesn't change because you get exactly offsetting effects. And finally, maybe any of the above will happen depending on the company you're looking at and what debt ratio. And that actually is the right answer. Debt is not an unmixed blessing, it's not an unmixed curse, it's a mixed blessing, and the net effect will be positive for some companies for some portions of debt. But even for that company, at some point in time, debt will rear its bad side up, and that's when you stop. That's the optimal debt ratio for a company. It's a different way of thinking about the right mix of debt and equity for your company. Any questions on cash flows? I know you guys want to get away for the long break. I'm not going to let you go yet. So let's talk about the last piece of this puzzle. We're going to talk about growth. And don't worry, I'm going to keep this simple. Okay? Growth, of course, as we talked about, has a good side and a bad side. The good side is it pushes up earnings. The bad side is you've got to reinvest money. The net effect is what's going to drive value. So anytime you sit down to value a company, you're going to have to spend some time thinking about not just what growth your company will have, but what value that growth will have in your company. So generically, there are three ways you can estimate growth, and only three. So you sit down to value a company. Here's the first way you can think about growth. You can look at the company's history to see how quickly this company has grown in the last year, the last 5 years, the last 10 years, historical growth. The second is you can look outside to see if somebody else can give you a growth rate, analysts, managers. You'd be amazed at how many discounted cash flow valuations the growth is an exogenous input, a number that comes from outside. And the third way you can estimate growth is you can estimate growth based on what the company does. You think, what does that even mean? To grow, a company ultimately has to reinvest and reinvest well. That combination is what drives growth. So maybe there's a fundamental growth you can estimate. I'm going to push you towards the last approach, but I'm going to be as open as I can about the first two. So let's first start with historical growth. I come to you with a company and say, what was your growth rate in the past? That should be an easy one, right? That's like a fact. Well, let's see what can go wrong when you talk about past growth. The first is the growth rate you get for your company can depend on first how you compute that growth rate. An arithmetic average, we add up numbers and divide by 5, or a geometric average, a compounded average. It can be very sensitive to your starting point and your ending point. I can almost guarantee that if you make 2009 your base year for earnings for your company, you're going to get a really high growth rate. You know why? Because 2009 was an awful year for many companies. So you picked a bad year as your base, you're going to show a high growth rate. You're saying that's cheating. Okay? You've got to be open to that. It happens. Okay? The second is, if you're looking at revenue growth, you're going to see a very different number than EBITDA or EBIT or net income. So you've got to be very specific about the metric you're focusing on. And finally, there are some little mechanical details that can get in the way. If your company goes from negative earnings to positive earnings, I challenge you to tell me what the growth rate for that company is. It's almost impossible to compute as you go from negative to positive. And as your company scales up, you're going to have to be very careful about extrapolating growth. So let's end with a very simple table. This is actually a table for Motorola, where I took 1994 through 99 numbers on revenues, EBITDA, and EBIT. In fact, I have net income and earnings per share as well, which I couldn't fit on this page. So I have three metrics. I've got revenues, EBITDA, and EBIT, 5 years of numbers. I've computed two different growth rates for each of these measures. I've computed an arithmetic average growth rate and a geometric average. For revenues, the numbers are pretty close, right? 7.08 and 6.82. When I get to EBITDA, the numbers diverge more. And when I get to EBIT, they get wildly different. So I have a question. Why do arithmetic average growth rates and geometric average growth rates diverge as I go from top line down to bottom line? Let me ask you a different question. Under what conditions will your arithmetic average growth rate and your geometric average growth rate give you exactly the same number? What has to be true about your company? Your growth rate has to be a constant, right? If I had 8, so if I get 8% every year for 5 years, the arithmetic average is 8, the geometric average is 8. The more variance there is in growth rates across time, the bigger the divergence. Now do you see why revenue growth is less affected by doing compounding than, because the further down you get in the income statement, the more variance is going to be in the numbers. So as you get to earnings per share, you can get huge shifts over time. And if you're given both growth rates, I would suggest you use the geometric average growth rate, because that really reflects reality. So I would suggest you look up the growth rate for your company. You can look it up on Capital IQ if you want. You can look it up on Yahoo Finance. But don't trust it, right? This is not a number where you should be letting somebody else do this for you. Take control of the process, and part of taking control is compute the average yourself. Do a geometric average, get a compounded average, and compare to the arithmetic average if you want. But when we start on next Wednesday, we will continue with our discussion of growth. But the first quiz does not cover growth. So it's all the way up to this slide, 152. Slide 152 is the last slide for the first quiz. You have plenty to do. So.
actually want to sell Facebook and the
Facebook has the highest revenue. So Facebook is number of users, like 50 minutes a day. Typical user in the US spends 50 minutes a day on Facebook and Instagram. He spends 50 minutes a day on Google and YouTube. He spends 27 minutes a day on Snap. He spends 3 minutes a day on LinkedIn and 1.5 minutes a day on Twitter. Twitter has a problem. That's part of the reason we're not able to sell ads. Is there are a lot of users who are using it, but they're not in Twitter anymore. So what Snap will be able to do is go to advertising say we have a market of 20 to 30 viewers. That's their
people who
core.
actually will spend money.
And also they're young, and they're very easily driven. So if you can develop an ad, build around video, is where the person starts because this is how you go. And I think that's fair. I think that's fair. Because this is how they're taking all out of it. And what they are doing is they're not doing it Facebook as usual. So they do Facebook Live. So they end up with 300 million users who are on for 40 minutes. That to me is incredible. Twitter, 150 million users, 5% on. And that's what we don't do.
Thank you so much.
I just have one question on the estimating free cash flows and equity. I'm not really so familiar with
But that's basically looking at the equity portion. Because you do free cash flow equity, you can take the equity. Let's say that investor goes to so 200 million. So 20% of net profits is going to come from the debt. You as an investor.
So is that a way for you to basically project like how much money you ask for the future? Okay, I get it. Thank you.
So you're saying like because cash is not liquid, it should not be.
If cash is invested in the by definition,
So how would you say I had this unsure of like how do you calculate working capital current assets?